If I asked you, Brian, what are some of the things you want in any investment, be it real estate or otherwise, I suspect you'd say something like, give me contractual cash flow, give me inflation hedging, give me downside protection in these volatile times, but I don't want to give up my upside.
Welcome to the Alts Report, where we explore the value of alternative investments and the trends shaping today's markets. I'm pleased to welcome Lauren Hochfelder, Head of Global Real Assets at Morgan Stanley Investment Management. Today, Lauren and I will discuss triple net lease investing. Triple net lease investing is a strategy within real estate that brings together credit-like underwriting and real estate investing. Lauren, thanks for joining us.
Thank you.
To start, can you provide an overview of what triple net lease investing is?
Sure. So net lease is really just a lease structure. Generally, as a sub-asset category, it refers to assets that are long-term lease, so think 10, 20 plus years, to tenants pursuant to this net lease structure. This is a structure in which the tenant pays the rent and all the expenses. So they pay real estate taxes and insurance and operating expenses. That means that as the asset owner, every dollar you collect in rent flows straight through to the bottom line.
Maybe help bring it to life for our viewers. Can you provide an example of a triple net lease transaction?
Sure. So again, for starters, I would say net lease is just a lease structure. So it can be many different types of real estate. It can be warehouses leased to names like Amazon or Tesla. It can be medical office buildings leased to NYU Langone or Mount Sinai here in New York. It can be retail assets, it can be robotics facilities, so it really can be a pretty wide range of assets. A classic example would be we just acquired a large Class A warehouse leased to a major household name immediately adjacent to LAX airport in Los Angeles. We have a 20-year lease. It sits on nearly 20 acres of land in an incredibly infill location, right next to this major transit hub airport, and one of the last mile facilities that can serve the incredibly dense demographics, in particular in West LA. So you have the benefit of the long-term income stream, you have the benefit of this piece of land and asset that we think over the long term should appreciate beyond the contractual rent steps.
A few things in there. First, mission critical, hard to replace assets. Two, you mentioned the quality of the underlying tenant, and I think that is why folks associate this with credit-like underwriting.
Yes.
And then long-term leases, so the ability to model out cash flows pretty well.
That's exactly right. If I asked you, Brian, what are some of the things you want in any investment, be it real estate or otherwise, I suspect you'd say something like, give me contractual cash flow, give me inflation hedging, give me downside protection in these volatile times, but I don't want to give up my upside. And oh, by the way, if you can throw in some tax efficiency, that would be great too. Well, net lease can provide all of that and enables you to also play some of the large mega trends that we think are driving structural demand and return growth over time.
So let's talk about portfolio construction. As you were out speaking with investors, where do you see this fitting in a portfolio?
Yeah, it's a really great question because in a sense, net lease is sort of a hybrid between real estate and a more credit-oriented asset. So we see investors putting it into either of those categories. I'd say for those who are thinking of it as part of their real estate allocation, they're saying, I get the real estate benefits, but I have the contractual income that can help insulate me from some of the key risks of real estate. What are the key risks? My revenue can drop, right? My rents can go down, I can lose a tenant and have vacancy. And my expenses can spike. I mean, you don't have to be a professional real estate investor to see what's happening with real estate taxes, insurance, et cetera. And in a net lease asset, for at least the duration of that long-term lease, you're generally mitigated from both of those risks because both are contractual. When we see investors look at it for their credit bucket, again, they're saying that I have this contractual cash flow.
Yeah.
Oh, by the way, it's escalating, but yet I'm not giving up the underlying benefits of hard asset ownership. Net lease, again, if you're choosing the right real estate, that mission critical real estate, that real estate that is operationally essential to their business, that is generally perceived as being a lower default risk than owning that same company's unsecured credit.
So let's close. We touched a little bit on interest rates, inflation, right? We're in an environment with elevated interest rates, likely higher for longer. What impact do higher interest rates have on real estate broadly, but also triple net lease investing?
Yeah, we think it makes it a particularly interesting time to invest in triple net lease because it emphasizes the importance of current return. So if you think about the different ways one can make money in real estate, coming out of the GFC, a lot of value, a lot of return was driven by interest rates coming down, right? You saw cap rate compression, you saw cheap borrowing. We think this time around is different because we do expect rates to stay relatively range bound at today's elevated levels. So that means you have to focus on current cash flow. It also means you need to be in those sectors and markets that benefit most from long-term structural drivers of demand, where you can see the greatest income growth potential. And so in a net lease, obviously you have contractual rent steps that are generally in line with and sometimes above inflation. But you also need to own the assets that once that lease rolls, you're in the right market that's benefiting from whether it's, physical AI with robotics or aging demographics with some of the medical office that we invest in. So you really need to be in those places where the income growth can compensate. In terms of the drivers of why we think rates stay elevated. One of them is certainly inflation expectations. And I would say that after 20 plus years of limited concern around inflation, investors are rightfully really focused on it today. So we're seeing a renewed appreciation for the inflation hedging benefits of real estate. And it's really for two reasons. One, you have the direct or indirect flow through to income. So the top line tends to grow with or above inflation. The second part that I think is a little less well understood is the flow through impact to supply. So in inflationary periods, construction costs rise, supply drops. And real estate, like everything, is just supply and demand. And so when we see supply drop off precipitously, as we're seeing in today's inflationary environment, you see the real potential for asset appreciation because the cost to rebuild that same asset just went way up. So that inflation hedging we think is key.
Lauren, that was great. Thank you for joining us and providing an overview of triple net lease investing.
Thank you.
We appreciate you all joining us for this edition of the Alts Report. To learn more about alternative investments and our platform at Morgan Stanley, please visit morganstanley.com/alts or reach out to your Morgan Stanley financial advisor or private wealth advisor. We look forward to seeing you next time.